Brace yourself. We're going to have a massive tax bill that should be passed sometime in 2025, but if I know how Congress works, it's probably going to be passed at the very last minute. Now, the tax bill is not drafted yet, but I do have the tax outline from the Ways and Means Committee, which is the committee that determines the tax policies and tariffs that I want to show you so that you have a better idea of what Congress is thinking about. So in this video, I'm going to break down tax cuts, tax increases, and little details they have in this outline that could have an impact on your personal finances. So let's talk about what's coming. Many of you remember the Tax Cuts and Jobs Act, or TCJA, from 2017, or almost 8 years ago, during President Trump's first term. It was the one that shook up the tax system, lower rates, and simplified filing for some people. Well, most of them in the first TCJA are set to expire on December 31st, 2025, including your personal income tax rates. And President Trump has made campaign promises that he will pass the second Tax Cuts and Jobs Act, or TCJA 2.0, when he's elected. And I think most of you know by now that he has been doing what he said he's going to do. But here's the thing. Lawmakers are debating whether to extend, tweak, or completely rewrite those tax cuts. And the argument is that keeping those tax cuts will give the economy a boost and leave more money in people's pockets. But there's a catch. According to the Tax Foundation, which is heavily quoted by the Ways and Means Committee in this outline, it'll cost the government $4.5 trillion over the next decade. And that's a whole lot of money that's got to come from somewhere, right? And then there's Trump's new tax cut ideas, things like no taxes for people making less than $150,000 a year, no taxes on tips, Social Security, and overtime pay, which I'll get into those later on in this video. The bottom line for those who just want to comment without watching the whole video is that the TCJA 2.0 could shake up tax bills for millions of Americans, but whether it helps or hurts you depends on how the final version plays out. First, let me briefly go over what's expiring on December 31st, 2025. If Congress doesn't step in, we're looking at higher tax rates, lower deductions, and some pretty big changes for businesses and individuals. And the first on the list is the individual tax rates. Once 2025 ends without the TCJA 2.0, we're going to go back to the pre-2017 marginal tax rates. As of right now, our marginal tax rates are 10, 12, 22, 24, 32, 35, and 37%. But if nothing gets passed this year, then we'll go back to the way it was before 2018 at 15, 25, 28, 33, 35, and 39.6%. This means all of the tax brackets will shift upward, and you're going to end up paying more federal income taxes. And second, TCJA almost doubled the standard deduction, making tax filing easier for most people. But without the TCJA 2.0, starting in 2026, the deduction for single filers will drop from $15,000 to around $6,500. And as for married couples, the deduction will fall from $30,000 to about $13,000. But please also keep in mind that those pre-2017 standard deductions will be adjusted for inflation from 2017 to 2026. And this means more people will need to itemize deductions again, and which makes tax season way more complicated. And since 2018, about 90% of Americans have filed their taxes with a standard deduction. And third, the child tax credit. Right now, families get a $2,000 tax credit per child, but after 2025, it drops back to $1,000 per child. And fourth, the SALT deduction cap. And TCJA put a $10,000 cap on deductions for state and local taxes, also known as SALT. This one applies to people in high tax states like California, New York, and New Jersey, but after 2025, the cap disappears, meaning those in high tax states can deduct more again, but it mainly benefits higher earners. And fifth, we got the estate and gift tax exemptions. Right now, you can pass down $13.6 million tax-free and $27.2 million for couples. But after 2025, the number drops to around $5 million, meaning more estates will get taxed. And then there's the pass-through business deduction. So if you're self-employed like me or own an LLC, as corporation or partnership, you've been able to deduct 20% of your business income thanks to TCJA. But after 2025, that Section 199A deduction is going to be gone. And that's going to be a nightmare for my spreadsheet for sure. And seventh, the bonus depreciation. Businesses currently get 100% bonus depreciation, which allows them to write off equipment purchases immediately. And this one drops to 50% in 2025 and will disappear by 2027. And moving forward to the eighth, which is expanding the mortgage interest deduction. And this means TCJA limits the mortgage interest deduction to home worth $750,000 or less. But after 2025, the old $1 million limit combined with your first and second homes will come back. And next, the charitable donation limits. Right now, you can deduct 60% of your adjusted gross income for charitable donations, but after 2025, it drops back to 50%. And there are many tax provisions expiring after 2025, and you can read about them on the congressional website, and I'll put that link in the description below. Now, let's talk about what's in the pipeline for the TCJA 2.0 according to the Ways and Means Committee. If you've never heard of the Ways and Means Committee, just think of them as the architects of tax laws in the House of Representatives. And they've been around since 1789, so they've been doing this for a while. And basically, they're the ones who handle all the taxes, tariffs, and how the government raises money. And they also oversee big programs like Social Security, Medicare, and unemployment. So they're not just about taxes. They're also deeply involved in a lot of the economic policies that affect your daily life. And because tax laws have to start in the House, this committee has a lot of influence over how the government gets its funding. So they have a significant power over what goes in and out of your pocket. Not to mention, 8 presidents, 8 vice presidents, 21 speakers of the House, and 4 justices of the Supreme Court have served in this committee since inception. But anyway, the number one tax proposal that got everyone's attention is eliminating federal income tax for individuals earning less than $150,000 a year. That's 76% of the American households who will no longer require to pay federal income taxes. That would significantly increase your take-home pay. But on the other hand, critics warn that cutting such a large revenue source could explode the national deficit unless offset by spending cuts or adding additional tax revenues. The big question is, how would the government make up for the lost revenue? Would it mean cuts to Social Security, Medicare, or other critical programs? Or would it rely on increased borrowing? It's hard to say at this point, but if you ask me, while the idea may sound attractive, it's the details that will determine whether it's a tax relief miracle or a financial disaster waiting to happen. Do I think it's going to happen? I don't think so. Not while we still have over or almost $36 trillion in national debt. Another bold tax proposal Trump is floating is eliminating taxes on tips. And if you're a server, bartender, hairdresser, or anyone who relies on tips, this could be a huge win because it means more money in your pocket and no IRS headaches. And tips are already earned income, so why tax them again, right? So some may argue that this move would directly benefit lower income workers who rely on gratuities to make a living. But critics say it could open the door for underreporting and tax loopholes, which reduces overall tax revenue. Plus, would businesses still report tips accurately if they're untaxed? While this proposal is music to the ears of service workers, the fine print will determine if it actually gets passed. Could this happen? I think there's a 50% chance that it'll happen. I think the tipping culture went out of control since COVID, and some people may just oppose the idea of tipping in general, so we'll see how this goes. Now, another headline-grabbing proposal is eliminating taxes on overtime pay, and the idea here is simple. If you put in extra hours, you should keep every dollar you earn, which means no extra cuts for the IRS. Some say that this would reward hard work, but maybe even boost productivity and put more money in workers' pockets. Imagine pulling a 60-hour work week and actually seeing all that extra cash in your paycheck. But like most tax loopholes, the devil is in the details. So let's see if this enticing offer to grind out those extra hours is actually too good to be true. And I actually think there's an 80% chance that this will be added to the bill because I think there's going to be a lot of support from the American people on this. Is this going to encourage more people to pick up more hours or extra shifts? Absolutely. And for those working outside the US, here's the good news for you. They're proposing either no more income tax for Americans living abroad or raising the exclusion amount to a higher limit. So right now, the US is one of the only countries that taxes its citizens no matter where they live. That means whether you're working in Paris, Tokyo, or Dubai, Uncle Sam still wants his cut. And if I had to guess, they're going to cap the limit at something like $150,000, but that's just my guess. But what if you can write off the interest on your car loan just like you can with a mortgage as an itemized tax deduction? That's exactly what this proposed tax change aims to do and bring back the auto loan interest deduction. And right now, personal auto loan interest is not deductible, meaning you're paying extra for the privilege of financing your vehicle. But under this proposal, borrowers could deduct interest payments on their car loans, which reduces their overall tax bill. And however, it is unclear if this is going to be an above the line deduction or an itemized deduction. So we'll see how this goes. Now, the estate tax, better known as the death tax, is one of the most controversial taxes on the books. So when you're basically dead, the government is still going to want a piece of your tax. Right now, when someone passes away and leaves behind a large estate, the federal government takes a cut up to 40% on amounts exceeding the exemption limit, which is $13.99 million per person in 2025. Trump wants to scrap this tax entirely, and those in favor say that eliminating it would help family businesses, farmers, and generational wealth stay intact. Critics, however, say removing it would only benefit the ultra wealthy and make wealth inequality worse. And let me know in the comment section down below how you feel about this one. And I know it's stupid to have the estate tax, especially when it's for my kids and grandkids. And the corporate tax rate is getting slashed even further, down to 15 or 20% from its current 21%. And this would be a major expansion of the 2017 TCJA, which already cut the rate from 35% to 21%. And this will make the US more competitive globally to attract businesses and fuel job creation. But this could balloon the deficit and disproportionately benefit large corporations. And a lot of corporations already pay little to no taxes due to deductions and loopholes, and further cuts would drain federal revenue without guaranteeing wage growth or economic benefits for average workers. How about you? Love to know how you feel about the comment section down below. And I am always apolitical, but as a business person, and I'm a business owner, I know there are a lot of great benefits to the business deduction. So, we'll see how this one goes. Now, the Earned Income Tax Credit, or the EITC, is one of the most significant tax benefits for low to moderate income workers. But Trump's proposed changes could reshape who qualifies and how much they receive. So what's on the table? Some proposals suggest that expanding the credit for certain workers, especially those without children, to encourage workforce participation. And others push for simplifying the system by reducing fraud and improper payments. Something critics argue could lead to fewer people qualifying. And if this proposal does move forward, it could mean a bigger paycheck for some, but a tougher qualification process for others. And as I mentioned earlier, the SALT deduction has been a political hot topic ever since the TCJA capped it at $10,000 in 2017. And now Trump is considering just getting rid of it altogether. So what does this mean? Right now, taxpayers in high-tax states can deduct a portion of what they pay in state and local taxes from their federal tax bill. If the SALT deduction is fully repealed, these taxpayers, especially high earners, will lose a key tax break. But the second option is to raise the SALT deduction cap from the current $10,000 limit to $15,000 for individuals and $30,000 for married couples filing jointly. And why does this matter? Right now, if you live in a high tax state, you can only deduct up to $10,000 in state and local taxes from your federal return. Raising the cap would give higher income taxpayers in certain states some tax relief, especially for homeowners facing high property taxes. And some say this adjustment would help middle-class families who got hit hard by the TCJA's deduction limit. And however, some argue that increasing the SALT cap will mostly benefit wealthier taxpayers since low-income households typically don't hit the SALT cap anyway. Now, let's talk about how these tax changes might take a hit on your paychecks. Now, when it comes to industries like hospitality, healthcare, and transportation, some employers provide tax-free meals and lodging to employees. However, there's a push to end this tax benefit, meaning employees will have to report these perks as taxable income, or maybe it's the employers who would have to report them. If implemented, businesses might have to rethink how to compensate employees, which can lead to higher wages to offset the new tax burden. Now, one of Trump's most controversial tax proposals is the elimination of the home mortgage interest deduction, or the HMID, a move that could potentially shake up the housing market and homeowners who itemize their deductions. And right now, homeowners can deduct interest on mortgages up to $750,000, which is down from $1 million pre-TCJA. This deduction has long been a major incentive for homeownership, especially in high-cost areas where housing prices are steep. The argument is that the deduction mainly benefits higher-income households and inflate housing prices, and by removing it, the government could simplify the tax code and potentially reduce the deficit. But here's the flip side. Eliminating the HMID could discourage homeownership, making renting more attractive and hurt homeowners who rely on the deduction to avoid their mortgage payments. And I would love to hear your thoughts on this in the comment section down below. So what do you think is better? Investing $500 a month, making 10% return, or investing $1,000 a month, making a 7% return on investment? You can't figure out how much you can invest without a budget. There's no way around it. I personally tested out the budgeting app called YNAB, and it's not just an app that can track your income and expenses, but it can even help you create a plan to pay down your student loans, car loans, personal loans, or credit cards a lot faster. So if you're ready to change your life by getting out of the paycheck to paycheck cycle, you can get a free trial without any credit card information by using the link in the description below. Now, one of the tax overhauls includes a controversial shakeups for the healthcare industry, and that is to eliminate the nonprofit status of hospitals. And many hospitals operate as tax-exempt nonprofits, meaning they don't pay federal income taxes in exchange for providing community benefits like charity care for uninsured patients. The idea behind Trump's proposal is that too many hospitals act like for-profit businesses, which rakes in massive revenues, paying executive millions and still charging sky-high medical bills. If this goes through, I expect major resistance from the healthcare industry and a fierce debate over whether hospitals should be treated as businesses or public service institutions. This could also make an impact on healthcare workers with student loans on the PSLF status or the Public Service Loan Forgiveness Program, which could make them ineligible if hospitals lose the nonprofit status. And this is a big one, and this is to get rid of the head of household or HOH tax filing status, a move that could significantly impact single parents and caregivers. And right now, HOH filers get a larger standard deduction and lower tax rates than single filers, which helps ease the financial burden for households with dependents. And if this status is eliminated, millions of single parents, especially those earning middle-class incomes, could see their taxes go up significantly. And some would argue that HOH status is overly complex, full of loopholes, and a simpler flat tax structure would be more efficient. But personally, and I think this would hit low and middle income families the hardest, making it more expensive for single parents to raise children. So you've probably heard Congress wants to replace HSAs with a universal savings account, and here's why that matters. By switching from HSA to USA, we're going to lose the pre-tax contribution benefits, which lowers our taxable income. And right now, HSAs lets you stash away money tax-free, but only for medical expenses. On the other hand, a USA or universal savings account offers more flexibility, and you can save for healthcare, a house, retirement, or even a last-minute vacation, all without getting hit with tax penalties. Sounds great, right? But some experts worry that without the healthcare-only restriction, people might spend their savings too quickly, and which would leave them short with, when real medical emergency hit. And others argue that it's your money, your choice, and a USA would put more financial control in your hands. Again, drop a comment below and share your thoughts on this issue. Are you a pro HSA or would you rather have a USA? And I'm going to make a separate video on this, so be sure to subscribe if you haven't done already. And the other option is to pass HR 5688 instead of getting rid of the HSA. And this bill aims to make the HSAs more accessible and flexible, which helps Americans save more for medical expenses tax-free. And the proposed improvements include higher contribution limits, letting individuals and families set aside more pre-tax dollars for healthcare, and also expands eligible expenses, potentially covering things like over-the-counter medications, fitness programs, and even more alternative treatments. And additionally, the bill seeks to allow more people to qualify, including those on certain insurance plans that currently don't meet HSA requirements. And the other proposal is to eliminate the child and dependent care tax credit. And please don't confuse this with the child tax credit. And as for the child and dependent care credit, or the CDCC, it helps working families provide a tax break on child care and dependent care expenses. And getting rid of this credit would mean parents and caregivers lose a key financial relief, and which makes it more expensive to afford daycare, after school programs, or care for disabled dependents. Now, for the student loan interest deductions, currently borrowers can deduct up to $2,500 each year, which reduces their taxable income. Eliminating this deduction would mean higher tax bills for millions of Americans who are still paying off their education debt. But then, with student loan balances at historic highs, removing this deduction could be a controversial shift in tax policy. With the recent news to completely shut down the Department of Education, I think anything is possible at this point. So look, I know all this talk about budget cuts, taxes, and debt can be overwhelming, but here's the thing. Is TCJA 2.0 going to improve your personal finances? Is it going to pay off your debt? Is it going to make you a millionaire? Of course not. I want you to take control of your own finances first. Congress is going to do what Congress is going to do. You have control of your own household finances, and that's where it begins, no matter what Congress or Trump is going to do. Do I agree with every proposal in this tax outline? Of course not. I'm sure you're going to have some disagreements in this document. No matter what they decide to do, somebody will always disagree with them. And the key is balance. Cutting waste, keeping taxes fair, and making sure every dollar is spent wisely. It's a challenge, no doubt, but hopefully they'll make the right choices so we can build a future that works for everyone. And this has been another beast of a video, and I hope you got a lot out of it.